Hi everyone, my name is Simon Mishevich from Optimize Accountants, and in this video I'm going to be talking about the 87% tax on UK pensions. That's right, 87%. Now, yesterday I launched a video talking about an 85% tax rate, and in that I left out some of the details because, well, I didn't feel that it was appropriate and it was a bit too much for some of our viewers. However, there were some people calling me out saying I'm not a good accountant, should be advising my clients. So for you in particular, enjoy this video because you're right that it's not 85%. In actual fact, it's not less, as you said, it's actually more. So let's get into the detail of why I'm claiming that the tax is 87%. Before you do that, there are some interesting channels that I think you should be watching. The first one is the expat tax. If you have had enough of the UK, you want to live or work abroad, then you might want to consider the expat tax channel, which will help you do that. And the far right is moving to Marbella, Spain, which is where Louise and I are. And again, feel free to follow our journey as we move from the UK to Spain. If you want to download our free UK property tax guide, feel free to use that QR code currently showing on screen. But let's get into the details, and I'm going to give a bit more narrative. So this video will be longer, which goes against my YouTube analytics that says most of you only watch these videos for 4 minutes. So it'd be interesting to see which 4 minutes you actually watch. And most of the critics I've noticed don't read the entirety of the video because some of the things that they were saying in those criticisms was actually in the video, but I've put that in this even more clearly. So UK pensions, under the Labour Party autumn 2024 budget, pensions in the UK will be subject to inheritance tax starting from April 2027. Further, currently unused pension pots can pass through tax-free if the individual dies before 75, which I think is horrific to pretty much ask someone to die before 75 for tax reasons, right? I'm not suggesting they are saying that, but you can see, look at the just narrative. It just feels horrible. Anyway, so let's have a look at what that really means. And it goes on to say, this wasn't included in previous video. In the UK, an individual can benefit from Nil Rate Band, RNRB, which exempts the first £325,000. This is going to come back quite heavily through this video of their estate for inheritance tax. Additionally, if the home is passed direct to descendants, they may qualify for the Residential Nil Rate Band, RNRB, providing up to an additional or extra £175,000 of tax relief. But there is a taper relief of this Residential Nil Rate Band once assets gets over to 2 million. Please do note, this is what I'm going to be coming back with, and this is why that the pension tax is going to be more than 85%, as I previously stated in my video. UK IHT is 40% on pensions, and why is that? The reality is that pensions will be subject to 40% because the lifetime allowances may be used on other assets, such as their home. So when pensions come into their estate, it may exceed the IHT lifetime allowances, which are used on other assets, and therefore will be taxed at 40%. But it's not 40%, and I'm going to prove why. So the net pension, let's have a look at this. So this is something I put in the previous video. So I'm looking at the basic rate taxpayer, high rate taxpayer, and additional rate taxpayers. And this is for receiving inheritance and specifically a pension. Now, this doesn't change across these tax rate payers at all. Pensions, 100,000 across, IHT charge, £40,000 because of course it's 40%. Net pension is £60,000, tax rate 40%. I think everyone follows that. I don't think there's any questions about that. But what I do want to focus on the effort on, and this is where it jumps up from 40 to 60%. And I'm going to clearly state why in this video, which I left out some of the details in previous videos. The Residential Nil Rate Band, RNRB, is reduced by £1 for every £2 that the value exceeds 2 million. So if you think about your home and you think about pensions and other assets, once they go over 2 million, you start to lose your Residential Nil Rate Band. And that could be quite a piece of bad news. So what I wanted to do is, in the previous video, I left this out. But because everyone was criticizing it and saying, well, you didn't give enough detail, blah, 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 which guys, I know you're going to be watching this video for 4 minutes, so probably not going to be watching this video detail either. Anyway, I'm going to put it in. So this is the worst case scenario. Okay, this is a sensationalist piece. I get it, but it can happen. And therefore, some of the people watching this video, it will relate to them. For the vast majority, it won't. But I want to be sensationalized because I want you to pay attention that there will be a tax liability on you. Not just you, but your children or your grandparents or whoever has pensions and other forms of assets. I want you to just look around, not just you. You should look at upwards in terms of your parents, your grandparents, or even your children. Look all the way linear across your family because it will affect you at some point. So before 2027, taxable pension is zero. You might have £100,000 worth of pension, but it wasn't taxable. After 2027, it will be taxable. So the difference is 100,000. A home may be £2 million. Now, again, people will say, well, the average house price is 300,000. How is that going to affect people? I get it. This is not going to affect everyone, but I do want to show that the numbers stack up of why there is so much tax. And the unsuspecting people that have quite good assets, and I know there's a lot of people who don't like other people with assets, guess what? Earn a living, get your own assets, and build your own wealth. Don't bring everyone down to your level, go up to their level, okay? So that's my view on those critics out there that don't like rich people. £2 million worth of home. IHT reliefs, therefore, is £500,000 because you had your £325,000 normal lifetime allowance plus £175,000 residential nil rate band. But because of that pension after 2027 becomes your pot, your assets exceeds those allowances. So now your IHT reliefs is reduced by £50,000, which is £450,000 total reliefs. So to explain that, which again, I didn't put in my previous video because I know people won't be here to watch all of this video, that the IHT release was 500,000 before the regime, but now we got this tax on pensions. The release is £450,000, and that's because you get the residential nil rate band reduces once you for £2 for every £1 over the £2 million mark. Complex, I get it. Speak to your accountant if this affects you. So therefore, the taxable assets subject to IHT used to be 1.5 million. Now it's 1650. Why 1650? Well, you have your pension which comes in, which is the additional £100,000. But because you lose your residential nil rate band, you also have an extra £50,000. Now that is taxable. And in my view, that is a tax that should be attributed to pensions. And we'll follow this through. So taxable subject to IHT, 1.5 million versus 1.65, variance of 150,000. IHT at 40% is 600,000 before the changes of 2027. Once the changes come in, adding in pensions, the tax is now 660,000. Therefore, the tax increase is an extra £60,000. Before I go on, I just do want to, and I know some people will criticize this element, but here you go. The extra IHT caused by the loss of the residential nil rate band will be paid out of the house proceeds once sold, not the pension. So you're not decreasing the pension pot, you're actually going to be paying the tax on the home. The pension pot will be transferred to you once the IHT of 40% is levied against it, which means there's extra tax caused by the Labour Party. So the pension of £100,000 is going to be transferred. However, you get the £40,000 deducted at source as a high rate taxpayer. And after 2027, we can't forget the additional residential nil rate band charge of £20,000, which are highlighted in previous slides, which means now the IHT, in my opinion, is £60,000 attributed directly as a result of these changes on that pension of £100,000. As a result, IHT effective rate, in my opinion, is 60%. Okay, so that is something that you need to swallow, and you need to go through these numbers again. So pause and rewind. So the net pension, so this is the 100,000 less the £40,000 that is deducted at source. Don't forget the extra £20,000 caused by the loss of residential nil rate band is not taken into account here because that would be against the home. So the net pension received as the 100,000 less the 40,000 is 60,000. We are now going to look at three columns here: the basic rate taxpayer, the high rate taxpayer, and the additional rate taxpayer. So we're looking at income tax now. And you'll see here that the income taxpayer for basic rate is 12,000 versus 24,000 for high rate taxpayers and 27,000 for additional rate taxpayers. Net pension, one less the other, 48,000, 36,000 and 33,000. But it gets worse. This is the worst case scenario. £100,000 pension, which has caused the issue of inheritance tax of 40,000 on the pension, plus the £20,000 of loss of residential nil rate band, plus the income tax charge that you will be have to pay. So 40% is 60,000, not £40,000. Income tax is 12,000, 24,000 and 27,000, which the total tax rate, as you can see bottom right, says 87,000, which is 60,000 plus 27,000, which is £87,000, 87%. Okay, so there's the details that wasn't included in my previous slides yesterday, which caused a lot of controversy and people say I shouldn't be an accountant. But there you go. So what can be done? Anyway, this wasn't the point of being right or wrong. The whole point of this presentation was to say that you will be paying more tax. Whether it's 40%, and let me just go back actually. Whether it's 40% and you've got income tax charge of 20%, it is still going to be considerably higher than what it was. My point of this presentation, rather than get into the semantics, which people love to get involved in, which, you know, it's unfortunate, is the fact that they missed the point of this presentation, is the fact that it is about you paying a lot more tax than you ever did before. That was my point, and I'm still sticking to that point. I'm not overly concerned with the semantics of the details because it will vary between people anyway. And yes, I did state the 87%, 85% yesterday, but I've now proven it's actually 87%, which you can see here clearly. And these are my workings, which I didn't include yesterday, but like I say, most people would have fell asleep by now or watched cats on YouTube. I don't mind which. But what can you do? I want you to take action. This is not about you being keyboard warriors and attacking. If it doesn't apply to you, fine. If it doesn't apply to you, great. If it does apply to you, any element of it, then you probably want to take some action. And some of the things you want to do is get some advice from a financial advisor. I'm not qualified to do so, but I do see other people take some actions. Some of them are me. So take the lump sum of 25%, which is tax-free, which will reduce your inheritance tax if you spend the money. Move country, like me, move country and take the remaining assets and cash abroad with you, and then lose your domicile status so that you don't have this issue going forwards. I live in Andalusia in Spain, and the inheritance tax rate is 1%. That's why I think you should watch this video channel about myself and Louise moving to Spain. Do not defer pension income. The reason I put that is deferring pension income without taking it could mean that you pay more tax on inheritance tax, and when it's passed over, then they're going to be taxed even further. So especially if you're nearing 75, you're probably better to take that money and then spend it on the family and enjoy it. Well, you should just enjoy life in general, don't you think? And get advice from your financial advisor. I've said it once, but I'm going to repeat myself. Get some financial advice. Like I say, if it's not 87%, I don't care. If you're not being taxed at 87%, but you're taxed at 40%, 20%, 10%, that's more than you were taxed before. So again, look at your grandparents, look at your parents, look at yourself, look at your kids, and think, what do I need to do differently to stop this tax burden in the future?